Welcome to the ACA conference in New York City. I'm Jane King. With me, Larry Holzenthaler of First Eagle Alternative Credit. And so interested to talk to you about the private credit industry because it just seems like it's gotten so much momentum over the past couple of years. Explain who uses private credit, what's it about, how's the market look to you?
So the vast majority of private credit is typically used to finance leveraged buyout activity, which that dynamic, issuing loans to finance leveraged buyouts, is actually nothing new. It's been going on for 25 years inside of closed-end funds, business development companies. But I think the way the market has evolved is towards basically bilateral negotiations between managers like us and companies to make them loans versus traditionally a lot of that financing activity was through the syndicated loan market. It would come through the big money center banks and get syndicated out. And these new private credit transactions typically involve sometimes one lender or smaller groups of lenders, but it just provides a lot of flexibility, a lot of different solutions for companies. And private credit really can involve not only corporate lending, but asset-based lending. So there's a lot of different ways that you can implement private credit. For us, where everything we do is on the corporate side. So that's really where you've seen a lot of the growth is direct lending to companies.
So you must be very dependent on interest rates, and those have been very interesting this year. I mean, how did that impact you, and where do you see interest rates going forward?
Absolutely. So these loans are typically SOFR-based, so they're floating rate, so they move up or down. So from an investment perspective, that gives the asset class very limited duration. So your coupon is going to move up or down with interest rates. So it's a bit different than fixed rate. But also from a capital markets perspective, these companies and more accurately, the private equity sponsors are borrowing at that cost. So as interest rates have come down already, but the economy so far has remained stable, we're actually already seeing M&A activity, in particular LBO activity, begin to increase. There's really been a lack of supply of new transactions, new leveraged buyouts the last couple of years with rates as high as they were. And that's already starting to normalize a bit, which is good. It creates more opportunities for people like us.
How do you see the economy?
The economy is doing really well. You know, one of the things I always say is we talk to a lot of companies. You know, we're talking to literally hundreds of companies on a monthly, quarterly basis. Everything we do is US. And these are everything from small landscaping businesses to multi-billion-dollar enterprises. And we're credit people, so I often tell our investors, we tend to be cynical. We tend to look for what's wrong versus what's going well because we are lenders. We don't own the equity in these businesses, so we're very focused on downside risk. And despite that, we still feel like the economy is doing really well. We're well into earnings season. You know, we've seen in the public markets twice the number of earnings beats versus earnings misses as an example. So we still think that, you know, even though there's potentially signs that the economy is weakening, on balance, certainly from a credit perspective, the economy right now is quite conducive to credit risk.
Interesting. Larry, thank you so much.
Thanks for having me.
Thanks.